This is a video about the connections between interest rates and exchange rates. We know that interest rates and exchange rates are both market prices. The interest rate is determined by supply and demand in the credit market, the exchange rate by supply and demand in the foreign exchange market. But these two markets are interconnected. And in particular, if we have a reduction in the interest rate, other things equal, this is going to tend to lead to a depreciation of the exchange rate. And of course, vice versa. Increases in interest rates will tend to lead to appreciation. I'm going to give you two explanations of why this is true, one of which is relatively straightforward, one of which is a bit more complicated, but they're both true and they both lead us to the same conclusion. The simple story just focuses on what happens when there is a cut in interest rates. So suppose, for example, the RBA expands credit and reduces interest rates. Now, the lower interest rates in Australia are going to mean that domestic assets start looking less attractive to foreigners. So their demand for Australian dollars to purchase Australian assets is going to fall. Equally, foreign assets are going to start looking more attractive to Australian investors, so they will supply Australian dollars to the market to buy foreign currencies in order to purchase those now more attractive foreign assets. So this shift inwards of demand and outwards of supply will lead to a decrease in the exchange rate. So that's a relatively simple story. It says if interest rates go down, exchange rates go down. The more complicated story is forward-looking, and it's based on something called uncovered interest parity. So to explain the link between interest rates and exchange rates, I'm going to have to set up a couple of things first. So let's imagine that investors expect that the exchange rate a year from now is going to be unchanged relative to today. An implication is that we should expect 1 year interest rates at home and abroad are going to be equal, because otherwise investors could make easy profits borrowing in the low interest rate country, lending in the high interest rate country. It's a little bit more complicated if we think that the exchange rate might change over the course of the year. Then we've got an arbitrage-like argument that suggests that an expected change in the exchange rate should be matched by a difference in interest rates, as set out in this equation. So in particular, if it looks like foreign interest rates are higher than domestic interest rates, then investors are going to expect an appreciation of the domestic currency. So that says, okay, suppose you were to, say, borrow at the low domestic interest rate and lend out at the high foreign interest rate. Well, the trouble is that when you want to convert those high foreign earnings back into the domestic currency, you'd find that the appreciation of the exchange rate would wipe out your gains. So if this equation, and this is what we call uncovered interest parity, if this equation holds, you can't make a profit by borrowing where interest rates are low and lending where they're high, because those interest rate differentials are going to be cancelled out by movements in the exchange rate. Second piece of my story has to do with the very long-run value of the exchange rate, and that we expect is going to be pinned down by purchasing power parity, by the idea that a similar bundle of goods should cost the same once we convert the currency in two different countries. Now, to be very clear, purchasing power parity is a terrible theory of the exchange rate in the short run. But if we're thinking about the exchange rate in the very, very long run, kind of over decades, then we do have a belief that this is kind of where the exchange rate is going to tend. And in particular, if the exchange rate is above this purchasing power parity value, we say the exchange rate is overvalued and we think it's going to have a tendency to depreciate in future. If the current exchange rate is below its purchasing power parity value, then we say that the exchange rate is undervalued. We expect that it's going to appreciate. All right, so now let's put these two ideas together. To make things concrete, let's suppose that initially the economy is cruising along with the exchange rate at the purchasing power parity value and domestic and foreign interest rates equal. And then suppose that the Reserve Bank cuts the domestic interest rate. Well, what does uncovered interest parity say? It says that now, because domestic interest rates are lower than foreign interest rates, we've got to expect future appreciation of the exchange rate. We've got to expect that the exchange rate looking forward is going to go up. But we also still believe that the exchange rate in the end is going to be tending to this purchasing power parity value. So the only way we can make these things consistent, the only way we can start right now at the purchasing power parity value, expect to end up at the purchasing power parity value, and expect to see appreciation of the currency in the interim is if the currency immediately depreciates. So what we expect is that when the RBA cuts the interest rate, the exchange rate is going to fall as well, because that validates the expectations of future appreciation of the exchange rate while staying consistent with the idea that the long run exchange rate is going to be at the purchasing power parity value. So that again tells us that a cut in interest rates will lead to a cut in exchange rates. And as I said, both of these stories, both the simple story and the complicated story, are true. What the uncovered interest parity story is a bit more complicated because it's forward-looking, thinking about exchange rates. The other story just focuses on what happens in the foreign exchange market at the moment of the interest rate cut. But in the end, they're telling the same story. A few observations on this. One observation is that I discussed uncovered interest parity in terms of nominal interest rates and nominal exchange rates, but it applies equally if we substitute real interest rates and real exchange rates. Any differential in real interest rates should be matched by an expected movement in the real exchange rate. The second implication is that there's an international channel in the monetary transmission mechanism. So now if we reduce interest rates, we know that that's going to lead to an exchange rate depreciation, which will tend to boost exports, will tend to lead to lower imports. So we'll tend to see increased net exports. So that component of aggregate expenditure will tend to go up. Uncovered interest parity also gives us another way of thinking about the impossible trinity. If we think about the case where capital is mobile and where the exchange rate is credibly fixed, then, as we saw a few slides back, uncovered interest parity tells us that the domestic interest rate has to equal the foreign rate. And that's just the same as saying that, therefore, the central bank doesn't have control over interest rates. It no longer has an independent monetary policy because it has to take as given the foreign interest rate. And the last point, just as kind of a technical footnote, uncovered interest parity is not actually riskless, so we shouldn't think of it as a true arbitrage argument. It's an arbitrage-like argument. And in fact, the so-called carry trade is based on speculators betting that uncovered interest parity is going to fail, and that they can bet on these interest rate differentials without having the gains being cancelled out by changes in the exchange rate. So the bottom line, just to go back, is the key thing for you to understand is just that there is this connection between interest rates and exchange rates, and other things equal, we expect that interest rates and exchange rates are going to tend to move in the same direction.